All right, so let's get started. So here we are, if everyone can see the screen, talking about some option strategies for bullish, bearish, or kangaroo markets. And yeah, so for bullish, we'll talk about long calls, bull call spreads. So if you see like bull calls, like calls are generally bullish if you're long a call, but if you hear the term like bull call, it means you're like, it's part of a spread. You have a long leg plus a short leg, and you can either have that strategy by starting with the long leg alone and then legging into a spread, which I want to talk about later, which is my favorite way to do a spread. And then finally, for bull strategies, talk about bull puts, which is just a paired long and short leg of a bull put spread. So there's a higher short strike and a lower long strike. Because you're aggressive, you think that the underlying will be neutral to bullish. And then bear trends, talk about long puts. That's basically, as you may know, with a put, if you're long a put, you're hoping the underlying decreases in price and breaches through your strike, and your option becomes deeper in the money as the underlying loses value. So like Ethereum goes through $500 in the money. And then also bear calls, which is a nice way to take in some premium when the market's trading sideways or down. So this one also kind of fits into Kangang, which we'll call into theta strategies. Same for bull puts. So these are also neutral to bullish. So anything that's neutral, we'll put into Kangang. And then also finally bear puts, which is just a nice way of saving money on your long puts by pairing a short leg with the long leg. Just a two-leg strategy. It's not as crazy as it sounds. And then finally, Kangang strategies, which are basically just these two right here. And so before we get started, I'll just ask if anyone has any questions or what your questions are, and see if there's anything specific you're hoping to talk about. And if there's nothing, we'll just jump right into it.
No questions from me. I'm excited for this.
All right. Good. So, long calls. So, I'll just type this out on the screen, but that's what we're talking about now. Type this out in the general chat. So, we have long calls, right? So, everyone here may have a rough idea of what that is, and if not, I can do a quick, brief introduction. A call is the right to buy, right? Which, if you're talking about it a lot, you're going to want to abbreviate as RTB. So you can just kind of equate a call with RTB if you're long, and if you're short, it's the obligation to sell. You're really just flipping the first and last letters. This trading right for this like ability. If you execute the contract, like let's say for instance, if you have a +1, so let's say you have +1 Ethereum, and let's say the end of the month be like, we'll just say the month, let's say August, which is our expiration. And then the strike, let's say 2,500. This is our strike. Let's say call. And then there's going to be a premium that you pay for it. And let's just make something up and say that for this premium, you're going to pay price of, I would guess, like 200. So if you are doing a full-size Ethereum contract, this is all hypothetical. the three key components of this option contract for a long call. All right. And so if you were looking at a chart, then you would see, you could visualize this as roughly like a green line at 2,500. So let's say here we see the price of Ethereum through time, and it went up to like 4,000, and then it went back to around 2,000, right? And you could say, okay, well, here's my strike somewhere up here at 2.5, and today we're going to open this contract. So we'll just visualize it. I like to visualize it like on the day. Like if you're going to open the contract, say, okay, here it is, and then here's our 2,500 strike, and it expires. So you have your opening date and your expiration date. It's just nice to visualize that if you are working with, if you're new to options. So you know this is like a really finite strategy. With options, the trade-off versus purchasing the underlying directly, like Ethereum. Ethereum will last as long as Ethereum lasts, but the option has a very specific defined expiration date. So there's a couple ways this could go. And when you see that green line on the chart, especially for a call, if you see a call, so here's your call option. This is a 2500C. What you're really hoping for when you see a call is you want a green call, like a long position. You want the underlying to, breach that line, and you want your option to become in the money. And in the money is just another word for at a trading advantage. Like a coupon, if you have a coupon for a pizza and the pizza is regularly $25, but you have a coupon to buy it at $12, then you're at a huge trading advantage, right? So a call is also like a coupon. And just like you can sometimes buy coupons that are really useful, like if a coupon is really good, it's going to have a price tag generally, right? But you can buy coupon books when you go to like some big cities, and you can go to lots of restaurants and save a lot of money on food and drinks and other fun experiences, because these coupons are really useful, and the restaurant owners love that because people are visiting their restaurant and maybe enjoying it so much that they come back again and again. So a fun way to think about a call is like a coupon, right? So what you really want here is a breach when you're long, right? When you're short, you don't want it to breach. So when you see green, it's like, go, please breach my strike, right? But it could go a few ways. It could go sideways as well. To expiration, and it could go down. In both situations, you're sad because the time value was depleted. So this option itself also has a chart. So this is a chart of Ethereum, and then there's also a chart for that long call you had. So this is the 2,500 call. So this also has a chart, and over time, if the underlying doesn't change, you're going to see that time value depleted, right? Time value is only worth that coupon is only worth it as long as you can go out and buy that pizza for $12. And every good coupon has an expiration date, right? So you look at that coupon on your refrigerator and you're like, all right, pizza, $12, let's do it, I'm hungry. But when you see the expiration date and they call you and they're like, okay, what's the expiration date? And you're like, oh, it was like last month. Then you're bummed out, right? So the option's the same thing. Your time value every day as you get closer to that expiration date are going to go down unless the underlying starts to move, or you have some unanticipated event that pumps premium into the option contract, right? So there's a few things that can do that. Is either IV or just the underlying movement. So if IV increases or the underlying increases, then the call could increase in value, even as time value is decreasing, right? So there's these forces that affect the premium, the movement of the premium. How are we doing so far? What questions does anyone have so far about any of this? Feel free to type them in the general chat. Okay, seems like everybody's good. If not, if anything comes up later, feel free to type it out. That's my favorite part, is like talking about questions live and seeing what questions everyone has. So we talked about long call, right? But the next thing I want to talk about is a bull call spread, right? So here we are, we talked about long calls. And now let's talk about bull calls, because this is actually a nice combination to do with long calls. Because if you do a long call alone, it can sometimes be a lot of premium, right? If we look at this contract here, we're looking at the premium rate, expiration, strike, and premium. $200 is a lot for some trading accounts. And even if it's not a lot, you can trim down that cost of speculating on the increase in price of the underlying. And conversely, you could also be defending a short position with a call option, right? This is a 2,500 call option. You could be short it from 4,000 and say, you know what, I just don't want it to go back up to that price. I'm happy down here, but I want to keep shorting it in case it goes down to 1,000 or 500 or all the way to zero. If you have your short position, you can defend it with a long call, right? But we're just talking about bullish strategies. This call, in this context, this call option is purely a long play, and you're hoping it breaches through your strike and becomes in the money, goes into in the money territory, right? Everything from here above is in the money, above 2,500. Right. But one thing you have to keep in mind is a break-even point, right? So you're just going to tack on your premium to your strike. BEP equals premium plus strike. So we have here, it equals 2,500 plus 200. In this case, it's 2,700. So if you're doing a lot of these, this is just one contract, right? Now imagine if you're doing hundreds of these, right? If you do at least 100 of these call contracts, you're going to be paying $200 per contract in premium. Just tack on 2 zeros to this. Then you're going to be paying $20,000 in premium for that position, right? Unless my math is bad, which it often is, but I think that's all right. So this is all hypothetical. That could be quite expensive, right? So the next thing we'll talk about is bull call spreads, where you're kind of getting a discount. You're kind of like hedging your long bets, right? And this is something that a lot of people kind of overlook. They just think long call, and they benefit from the extreme movement of the underlying, where it breaches the strike to the upside, and the call option becomes in the money. So a bull call is just a +1 long leg and a -1 short leg. And this is just one call here. It's just what you'll see is just a +1, like just for an example, Ethereum, expiration. Let's go further out, because I generally like to buy time when you're purchasing calls. If you buy near dated option contracts, you're just going to see that premium just deplete right away. which is a great thing for the market makers and for the brokers. But as a trader, you also want to think about your long term. You want to think about, okay, I want to buy time at Costco rather than at 7-Eleven. You know, you want to go get your big bulk bag of rice and beans, and they're healthier for you and they're cheaper rather than going to the 7-Eleven and like getting a hot dog or something that's going to kill you and your wallet, right? So you get a +1 Ethereum. Let's go out in time, right? Let's go to December. So this is our expiration. And then a strike, let's say maybe like 3,000. And then the premium we'll pay, and I'll just guess something random. Let's just say 100. And if anyone has the chain in front of them and wants to find that premium, feel free to do so and shout it out, but we don't need it. It's just all hypothetical. Just fun for involvement. So we have expiration, strike, and premium, right? The three parts of an option contract. We're going to pair that with a short leg. -1, Ethereum, and it's the same month, December. It's a vertical spread, so it's within the same expiration date. And then that's also really kind of alluding to other strategies you can think of later, such as like a calendar spread if you just want to take a lesser discount off of it. But let's keep it simple and focus on vertical spreads. But where calendar spreads really come in handy is when you're doing credit strategies, which we'll talk about in bearish markets. So we have this vertical because they're within the same expiration date. And you can see that really easily when you're looking at the option chain. When you go down and up and down the strikes, you're moving vertically. And then when you're moving like horizontally, you're going across different expiration dates, right? You click at the top of your broker's platform and you click the month and you change the month of your expiration date. You're kind of moving horizontally across time. Or if you're moving vertically, you're moving within the same expiration date, right? Which you can visualize just on the chart. Like as you're moving along, you're moving horizontally, and then within the same expiration date, you're moving vertically. So let's look at the next strike. We're going to go to a higher strike, right? So let's go to 4,000. And let's say you're going to collect some premium from that. Let's just make something up. Let's say 50. So you notice this strike is a lower strike. And this strike is a higher strike. Is this too basic, or should I keep going at this level? How's everybody doing?
I'm digging it.
Awesome.
Same here.
All right, cool. If you have any more questions, I'd love to know what questions you have. And if it's too simple, I can speed it up a little bit. So here's Ethereum. And then when you also want to think about this, don't just think about the Ethereum, also think about the option itself. So we have a 3000 C, and also you could imagine another chart with 4000 C. Remember that C just equals call, right? And what you're going to visualize for a call option, if the underlying moves flat, that time value is going to deplete, right? So we're going far out in time, right? So it's going to deplete rather slowly. It's actually going to move a lot more horizontally at first. And then once you get to 45 days to expiration, then you'll see a rapid decline where time values start to kind of move like that. All right, so try to do a little more accurate representation of this. It's going to move kind of down, and then around 45 to DT, it's going to move really fast. All right, and this is expiration date. is if the underlying doesn't move, if no movement in the underlying. So that's an assumption. So we'll look at the chart of Ethereum and we'll just say we saw it go up for a long time, and then around 1700, and then it went to 4,000 and back down, right? So let's throw our options on the chart, right? So we have, let's say this is 2, 3, 4. And this is all in thousands. So what am I going to do? We're going to go to our 3,000 strike and throw that on the chain. So let's open it today, and it's going to go out to December. And then same thing for our higher strike, 4,000 call. We're going to open that one, and it also goes out here. So this is our 4,000. Excuse me, 3,000. And this is our 4,000C. So in this case, you benefit from the underlying going above those strikes, right? You don't really want it to go between, and you really don't want it to go below. So there's like varying degrees of success of this strategy. So if it's down here at expiration, you'll be very sad. And then there's kind of like a continuum here where you'll be like more happy if it goes up here. If it's down here, all your premium is going to be depleted because it's not in the money. It's not far enough in the money. Like here's your levels of in the money, right? But if you breach both of these, you've reaped the full trading advantage, where you'll have the right to buy here, and conversely, you'll have the obligation to sell here. So you'll benefit from having purchased Ethereum at 3,000. So this is right to buy at 3K, and obligation to sell at 4K. And then you'll collect the net credit. Actually, in this case, you'll pay a net debit between these two strategies unless you leg in later, which was the next topic for this strategy, right? So you buy in at 3K, sell at 4K, and in this case, we paid 100 here, right? So we paid 100 and we sold for 50. So there's a net debit on this strategy of, let's write it out here. And I think I can go to the next, actually, I'm going to keep everything on this page. Let me scoot this over. So we have a net debit. It's just 100 minus 50. So that's 50, right? You can see that all here. 100 minus 50, because you paid 100 as a debit. You collected 50 as a credit. The debit is a credit. And then you have a net debit because you see that the strongest value that survived was a positive value, right? When you combine a bigger positive number with a smaller negative number, as you see, this one has a +1 ETH, this one has a -1 ETH strike, expiration strike premium. You have a net debit for the strategy, right? So we also call it a debit spread. And even if you leg in for a net credit later, like if you buy the long leg now and then later Ethereum moves up to 5,000 and then you sell a 7,000 strike, or let's just keep it in this example. So you buy Ethereum for, you have an advantage at 3,000 and then and then you leg in later to a 4,000 call when, like you say, Ethereum does go up to 4,000, you would collect a huge net credit for that strategy. You'd be getting paid premium on top of the benefit of being able to get that full 1,000 point movement between the underlying. So this is called debit spread, even if you leg in later for a net credit, which we'll talk about next. And you can see there's a net debit of $50, right? And so what does that mean? It means if you're up here, this level here, above 4,000, then you're in the very sweet spot, right? You know, you got the full 1,000 points of premium between those two strikes, the full 1,000 points of trading advantage, and you only paid $50. So you just say, okay, there's a 1,000 point strike difference between these, minus 50. So your net profit, your max profit is $9.50, unless my math is off. So you can see how much did you pay for this strategy? Only $50, right? And that's much better than, that's a huge advantage to having paid, $1,700 or 13. I'm sorry. Right now Ethereum is going for about 2,100. So if you had just bought Ethereum at 2,100, that's, if we're comparing 50 versus 2,100, you can see that, this number is far greater. So you're sacrificing time, and you're also sacrificing the potential that nothing could happen and the options could expire worthless. But you're only paying $50, right? In this hypothetical example. And then later, if everyone's still around at the end of this, we can look at some real examples and price out some real strategies. But you'll see similar results where the trading advantage to the underlying is significant in terms of capital invested. That's why options are so popular, especially at the moment with the extreme movement in the underlying. All right, so that's a bull call spread. And for anybody learning this for the first time, I'd love to ask what questions you have. Feel free to type them out. And don't be shy. I'll take a few seconds just to breathe and see if anyone has any questions. Okay, so we talked about long calls, which is just purchasing a long call alone. You can see, okay, I would have just paid this much in premium. And then we also talked about bull calls, where you would be taking a discount on the long call strategy for not as much profit potential. But if you keep your profit targets within some kind of calculated or estimated value, and you think it's only reasonable that Ethereum could increase to a given price that you predict, if you do the bull call strategy, you could end up, saving yourself the cost of premium by trading a little bit more conservatively. And then on top of this, let's talk about legging in. Which is starting with one leg, just purchasing the long call alone. And then later selling the short leg when it's more advantageous to do so. So it's kind of, you don't want to just think about one strategy or another strategy. I strongly suggest thinking about these strategies in combination. Like, you don't want to just do, I'm just going to buy 100 bull calls and 100 long calls Ethereum. You can also think, okay, instead of just doing that, I'll do 30% long calls, 30% bull calls, and then 30% I'll leg into those long calls that I purchase later by selling this short leg here at a later date when it's more advantageous to. Maybe there's more premium in it potentially. Or maybe not, and you still just want to take whatever is left and take a little discount on your long leg. You can use legging in to do that, right? So here we go. Talk a little bit about legging in. right? So the easiest way I can visualize this is like looking at a chart of Ethereum. And let's do it again. Say do this weird huge spike here where we go from 2K to 4K and back again. And we're thinking bullish right now, right? I think Ethereum could go to 15,000. Or later when we talk about puts, you can say, I think Ethereum could go down to 500. We have these potential movements and you want to play options with this, right? But for now, we're talking about bullish strategies, right? For this portion of this video, this learning group. So let's think, okay, we're thinking bullish movements. So let's say, okay, let's open some at 3K, right? Let's open some calls here. And so you put your line on the chart, right? Here's your expiration. Let's just say hypothetically it's in December. Here's your expiration in December. Go ahead and get bigger. All right, so let's think, okay, there's our opening chart. We have a 3,000 call on Ethereum. And it expires in December. Let's think, okay, let's do, do +3. And then right away we could say, okay, let's do 30% of this strategy as a bull call spread, where I'm going to have a short leg here. Just to keep it simple in intervals, say, okay, here's my other leg here, our short leg. See, excuse me. Right, so, and then these have the same expiration date. This line also goes all the way down. So this is our 4,000. This is our -1, 4,000 call, right? So 1/3 of our strategy was a bull call spread. And then we did that at this point in time here, but we could also open it another one here or here or here. And hopefully when you leg into a spread, you're really hoping that the underlying has moved up here when you're doing legging in. And you could pick any strike. You can get really creative with options. And that's why I love options. They're so fun because you can, it's really, don't just get stuck in a box thinking long calls and short calls or long puts, short puts. You can really think, oh, if I leg in later and leg into this bull call strategy later, I can do so at a huge advantage and maybe even in a net credit. So that if the underlying decreases later, so let's say I moved up here and you say, okay, now I leg in. Then the underlying can go back down. You could then close the short leg and potentially do so at a net credit. And I do this quite frequently. It's in my experience, it's very possible, but you don't want to just bank only on being able to leg in. You want to start off doing some of these, start off with the leg paired, at least one leg paired if you're doing multiple contracts. And then later you can leg in to this other contract by opening it at this point, or this point in time. How's that sitting with everybody? So basically you'd see one contract that opened here, and then another contract that opened here, and then you'd have only two more that you could do. So then you'd be at your full pairing at this contract here, right? This one over here. You could also have just legged into both other remaining potential short legs at this point. All right. So that takes care of that. And let's go back to our main screen and see what we want to talk about next. All right, we did bull calls. And then next, let's talk about bull puts. All right, so this is a bull put spread. Looks like my screen is not syncing. There it goes. So bull puts, this is a credit put vertical spread. Which I just abbreviate as CPV. And when you're talking to people about it, it's nice to just say bull put. So what this is a, really you're thinking about the short leg first, because that's the first one that you're worried about is like a line of resistance in the chart. So you have a -1 higher strike. This all really makes sense when we look at the chart, and you have a +1 lower strike put. Right? So let's throw it on a chart and see what that looks like. Again, same chart. And now we're thinking, okay, everything from this point is hypothetical. You know, here's our line in the sand. This is our present moment. We're looking at this chart. And you're thinking, okay, what could happen next? Here we are. The market's been moving this way in the past. I think Ethereum's going to keep going up. The market cap just keeps increasing. It has so much practical function and allure. It's and becoming a part of pop culture. And it's so easy to send money. Things like that has a lot of purpose. And there's a lot of software built on this. I see not very bullish on this strategy, but I don't have so much to invest in it. You can do a bull put spread, which is a nice way of saying, okay, I just want it to be neutral to bullish, right? So this is a neutral to bullish strategy. Because, and then you can visualize this because you're selling a put at a higher strike and buying a put at a lower strike, right? So let's say we're not super bullish. You could actually do this you could actually sell this in the money, but I personally don't do that. I say, let's go 3 to 10% below present value and then write these bull puts. And you're going to look at the premium and try to get a reasonable amount of premium for this strategy, right? And you'll do that. We can talk about this over time. If you say, okay, we talked about the bull put. Now you want to be selective about your criteria for opening a bull put. You want to think how much premium I'm getting for how much risk you're taking on, right? So this is like selling insurance. And then we could also talk about short puts, but that's taking full downside risk. You can do that, and there's nothing wrong with that, but I'm talking about just bull put spreads because it's a much more practical strategy for people starting out with trading, and it limits you from full downside risk, right? Because if you're looking at this chart, and this goes all the way to 0, do you really want to accept full downside risk? But let's say you're bullish, but you don't want to do that. You can do that with bull put spreads, right? So let's say, okay, I'm going to sell a -1 1700 strike. This is a put now, so now we're looking at the P. And then let's buy a strike below that. Let's do like, actually just to keep it in more like common intervals, let's go to 1500. And then let's go to 1000 for our long leg, right? So this is our higher strike. And now here's our lower strike. This will be a +1 Ethereum 1000 put. All right, so we have the criteria that we just talked about, and we looked at a practical example. You have a -1 higher strike here, and then you have a +1 lower strike here, right? You just move down down vertically within the same month, so it's a vertical spread. And it's neutral to bullish because you can see that you don't want it to breach, right? When you have a put and it's short, you see that red line, the red means no, right? You do not want it to go down there, right? So if we saw the underlying moving, we'll start to be happy as it's staying away from our strikes. And we'll start to get nervous and clench as it starts to move down or breach our strikes, right? And if it goes all the way through, we say, okay, we accepted full risk for this strategy. We didn't take full downside, but what we did say was we accepted the maximum loss here, right? So rather than taking full downside with a cash secured put, you are sitting on a much less risk than having done that, right? So in my opinion, the bull put or the CPV is much greater strategy than a cash secured put, right? And that's just in my humble opinion because of the downside risk you're accepting and the amount of premium you have tied up in the strategy. Right? So how's everybody doing with that? So you can see what you want in terms of being, in terms of how the strategy is going. You're going to be happy up here. And then there's varying degrees of success in the strategy here.
Can we do an example with numbers? Let's say the final strike price was the spot price of the underlying at the end of the period was 1400.
All right, let's do it. That's a great question because that's exactly what you want to talk about. So let's say, and then you can actually calculate this out based on your net credit and things like that. But that would be a much more advanced. If we do want to look at real examples from the chart, from the option chain, it's going to get more complicated. But this is perfect, and that's exactly what you want to be talking about. So let's say there's this point, and this point between the strikes, right? Between strikes, you're clenching. Not good, right? So there's 3 points. As you can already imagine, in this case, you want to be closer to the strike, right? If you're above here, you're good, you're golden, right? But if you're down here, things get kind of iffy. If you're down here, it's just kind of so it's not good, right? The strategy is not successful. So you can still get, yeah, yes, I'm listening. Go ahead, yeah, popcorn it out.
And if you get in the money, you still lose, no?
Not always. So here's the 3 situations. You have A, we have A, B, and C. As you go deeper in the money, as you can see by the smiley faces, and let me go ahead and zoom in here. As you go deeper in the money, your strategy will be less successful. But if you're near at the money, so this line here would be at the money. And then as you go deeper, it would be in the money. It would be at a trading advantage only to the holder. In this case, you have a writer line and a holder line. So if your net credit that you received for this short leg, right, you're going to receive a net credit for that 1500 put. Now let me go ahead and I'm going to go ahead and look at a chain while I'm talking about this. It'll just take me a moment to pull up a somewhat real value. This is and while it's loading, I'll just say you could be at a net profit for the strategy, right? For the credit you received of this writer line. You could be at a credit that is greater. Your profit and loss from this position could exceed the cost of, it could be greater than the trading disadvantage you'd be at with your obligation to buy, right? Because a long put is your right to sell, and a short put is your obligation to buy, right? You just flip the last 2 letters. So if we're looking at Ethereum, now I'm looking at a chart. Let's say we're looking at December, and we see a 1500 strike is about 190. So we collected about 190 for this. And then I don't have a quote for the 1000, but let's just guess that it's like, let's just guess 90 to keep it simple. So your net credit for this strategy would be 190 minus 90. Which equals 100. So you just need it to stay your break-even point where you're kind of neutral about the strategy, where you're looking between these strikes and where am I in the sweet spot, is going to be 1 point below, well, $100 below the strike. So like you said, 1400 is your neutral point, right? So 1400. So that's to answer your question. If you're at 1400, so you can actually visualize it right here. If you see that 1400, anything below that, you're losing money. And you get more loss as you go below that line. And it doesn't increase anywhere below this line. You know, you have, your losses are unchanged below the long strike, because at that point you have the protection of this long strike, right? This thing is your force. This is your line in the sand where you say, that's the limit of my downside risk in this bullish data harvesting strategy, right?
Okay.
Awesome. And if there's any part of that that didn't answer your question, I hope you ask again later at the end when we have a little Q&A at the end. So we have bull puts, and we talked about bull. So the three strategy we just talked about is long calls, bull calls, and we just talked about bull puts. And we got into some detail about how to manage that strategy and break-even points, things like that, right? Cool. So next, let's talk about some bear strategies. And these are very similar to the ones we just discussed, so we can breeze through it and then have a Q&A. A Kang Gang and Q&A, so. All right. So now let's talk about bearish strategies. And give me 1 second. So we're going to talk about long puts. So this is just a like +1 put option. That's it. Quick reminder, a put equals a, right? 2. So we abbreviate that as RTS. So what this means, you have the right to sell the underlying at a given strike until a specified expiration date for which you pay a premium, right? There's 3 things you keep in mind for any option contract: expiration, strike, premium. And if exercised, you're just going to sell that product, such as Ethereum, at the strike price, right? That's the net result. If you have it in your account, let's say you have Ethereum purchased at 2,000. When it went to 4,000, you sold a 4,000 put. It went back down to 2,000. You could still, at this point, if you had purchased a 4,000 put, you would execute it and you would sell Ethereum at 4,000 per unit, right? 4,000 USD per 1 unit of Ethereum. That's the trading advantage for a bearish market, right? So this is our bearish strategy number 1 that we're going to talk about today. So let's visualize it on a chart like we just talked about. Whoa. So here we have Ethereum, same chart we're going to talk about. So we have 2K, 4K, right? In recent history. So let's think, okay, let's say Ethereum had got up to 4K and we're sitting at this point. Okay, you could have purchased a 4K put at this point in time. Let's say you purchased it all the way until December. It expires at this date in December. And Ethereum went down, your option became deeply in the money, right? So we have a 4,000 put. And let's say you paid, it was at the money when you purchased it, and you just wanted to protect your position. Then you paid a premium to protect your underlying Ethereum investment. And you're now at a trading advantage for that put option. You could do one of two things. You could just sell the option, or you could exercise the option. And as we just talked about, if you exercise it, then you're just going to have the net result of selling 1/8 at 4K. And so as we discussed with Opyn v2, these are European style, and they exercise automatically if in the money. So if Ethereum stays unchanged and this moves on, and hypothetically, if you have this contract, at this point in time, the contract would automatically exercised, and then you will sell 1/8 at 4K, right? That's just the net result. So you'll take the full trading advantage from 4K to 2K, which is 2K, right? Of like instant arbitrage, pretty much. You can kind of psychologically think about it like that, but just think you're protecting your position, or however you want to think about it. Or you could think you bought the put alone without having an underlying investment, then you take that full profit rather than taking any loss on your underlying Ethereum investment. So if you were long Ethereum, your position would have been defended. If you didn't have that Ethereum underlying and you had the option alone, you would have that full profit between those two strikes. And the only thing that takes away from that is the premium you paid for the option, right? The expiration strike and premium, right? And so right now for December, at the money puts on Ethereum at 2,000 are about $425. So we could look right now, let's say hypothetically right now where we sit. So we have this movement up and down. Let's say now we're sitting here instead of up here at this point. So now let's think, okay, here we are roughly 2K, and you're thinking, okay, I want to defend my Ethereum investment. Let's buy a 2K put. Right now, those are going for about 425. So you'd open your line, and then you draw out your 2K put all the way to December expiration. This is a +1 Ethereum 2,000 put, and the premium you paid was roughly 425. So you can see that's a lot easier than shorting. If you just took a short position in Ethereum, I don't know where you can do that or how you can do that, but I'm sure there's some brokers who allow you, some exchanges who allow you to do that. It would be a huge, you'd be paying a lot of margin to do that. You'd be borrowing to take a short position. Whereas if you just purchase the option, it's only $425. Alternatively, it's a lot easier than just selling the stock because you maintain, selling the crypto. So if you have Ethereum, right, and you're really bullish on it, but you just want to protect, you're feeling like cautious, right? You're feeling like a little bit of turbulence is expected in the market, and you want to protect your Ethereum investment from downside move, but still maintain, let's say hypothetical positions. You have +1 Ethereum, then you can defend your strategy with a +1 Ethereum 2K put, right? Let's say you bought it at 500 or something like that. So you're sitting at a profit of 1,500 right now for that Ethereum, but you want to defend it with this put, right? How is that concept sitting in with everybody? What questions do you have?
It's good, like insurance.
Yeah, exactly. This is insurance, protection, whatever you want. And then you can also, what we'll talk about next, is bearish put strategies. And this is like, we don't need to go in detail because you could compare it to the bull call strategy we just discussed. In this case, the next thing we'll talk about is bear puts, where you're just going to hypothetically sell a short leg below this. So rather than enjoying the benefit of the full downside movement, in this case, you're going to say, I don't think Ethereum is going to go all the way to zero. Let's sell a put down here at 1,000. So this could be a 1,000 put. And then you could say, you know what? I don't think it's going to go all the way to 1,000. Let's sell this 1,000 put and take a credit on this leg to offset the debit of this leg. Right? You can also leg into that later, but obviously with anything that moves, anything on a chart, it has full upside movement, but only can go down to zero. You could do that with part of your position. Let's say you have 100 Ethereum. You could say, okay, I'm going to buy, I'm going to buy 50 puts now. I'm going to leg into some 1,000 puts below that. I'm going to buy 50, 2,000 puts. You have +1 Ethereum. I'm sorry, +50 Ethereum, 2,000 put. And then you can say, okay, I'm going to leg into half of them. So -25 Ethereum, 1,500 put. So you can say, and then later leg into more spreads. So you started with just a long put, and then you could later leg into a bull put, a bear put spread, right? Bear put spread. Just like we talked about earlier with the preceding strategies, you can leg in later, potentially at advantage, or just to reap a little bit of premium on the way out if you see that your insurance is fading in value. And just like car insurance or home insurance, you're going to want to look into renewing that insurance as it expires. And yeah, it sounds like a question. I would love to hear it.
I wonder, because for instance, when in the first example, you showed that the price of the underlying, in this case Ethereum, was obviously at the all-time high. And I can see that probably that was the best moment to buy a lot of puts. So you basically could sell at that price. But in reality, how expensive is it as an option buyer to buy those options? Because I guess option sellers or writers will be thinking like, okay, this is all-time high. We know how it's crypto. We have some signals, and this thing is gonna for sure going down. Is it still profitable for an option buyer to protect at that point your ETH, even though I guess the premium will be very expensive, no, or not?
Yeah, that's exactly the best questions you want to be asking and thinking about is. And that's why I gave one actual example was if we actually were looking at this case in the money at present, like hindsight is 2020. We don't know. And at this point, we didn't know that Ethereum was going to go down from 4K. But using this real example, we could say it was probably around this price at this time. It would be a little bit more expensive because of the time value between here and now, between then and now. So I'd say the option would probably be around 600, 700 or something like that as a put. And yeah, that could be quite expensive. But that's why you also think about the short leg to offset the cost and things like that. So it could be a speculative hedge where you
The short leg is you write options to recover part of the money that you are paying on the top.
precisely. Yep. In one instance, you sell for a credit to offset the cost of buying for a debit. Yep. And you can do that instantly. Like in some brokers, they allow you to do it within the same order. And, or you could do it individually on your own manually and just say, okay, now I'm going to go through and put in my long order. And then after that order executes and I complete and fill this position, I'm now going to go through and sell -1 Ethereum 1000 put. And you go through and do that next. So yeah, you can do it in the same order sometimes. You can do it later, a second later, a minute later, or you can do it a few days later. But I personally like to do it at least one at the roughly the same time. And then some of them I like to leg in later, potentially, in case the underlying does start to decrease and there's more volatility, more nervousness in the market. As you can see from this exciting picture of the bear market where things start to go down, you really want to protect yourself there, yeah.
Thank you.
Yep. So that's a great question. That's exactly what you want to be thinking about. You want to think about how expensive is the premium. Is it worth it to purchase a short, to purchase a downside strategy at this point in time? You know, you're dealing with people who are selling these options, the market makers and whatnot. They know a lot more than us, and they have to be ready to defend their position. They have researchers. They understand the market a little bit better than the average retail investor. So as we're speculating on this, we're thinking, okay, let's just weigh the pros and cons of our position. How much profit do we have realized already? These are the kind of things you want to be thinking about, you know, our realized profits. These are just a few things you might want to think about. You know, cost of premium versus your net equity. So is it, I generally suggest trading within 1% of your net equity per trade. This is one example. So whatever the option premium I'm looking at for me is like 1% of my total capital. And there's a lot of other things, if anyone can think of any other things to consider, I'll be glad to include that for everyone else to adopt as a strategy. But these are the two main things I think about: is how much profit I have right now, the cost in premium versus my net equity, and you know how costly is it me for defend my position. If I was to try to insure a Ferrari, it's not worth it, so I'm not going to take on that position. But if I'm going to insure like a Ford F-150, that would be a lot more reasonable. So that's probably the vehicle I will purchase and things like that. So it's all within your trade within your means. And also consider your past profits. Like let's say you've made a huge amount on it, and it's the cost to ensure your profit, that your presently profitable position. Like imagine we said in this example, let's say we bought Ethereum at 500 or less. You really think, okay, it's not going to cost me that much in the near term to insure my position because I've already made much more than that. And you could say I'm going to buy a bear put spread, hypothetically. So we just talked about long puts, and then we also kind of tacked on bear put spreads. And that was all we had planned to talk about. Oh, there's also bear calls. Excuse me. And this is just a credit call vertical spread, which we abbreviate as CCV. Or you can just say bear calls. But if you're writing it out in your calendar a lot and it gets repetitive, or you convert your spreadsheet, you can just write CCV or something like that. And what this is just like you can imagine, you have a chart and there's two legs. Whenever you hear bear or bull, there's a strategy with two legs involved. And in this case, you're going to have a +1 call, a lower strike. I'm sorry, a higher strike. And since my frame of reference should really be the low strike, that's the one I'm going to list first. -1 call at lower strike. So this is like a strategy I prefer to do when you actually have the underlying. You can do it alone if you're just speculating, but I prefer to do this as a defensive strategy. You can also do speculative, but with the volatility in the market we see right now, if you're just speculating on a bearish strategy, it could go against you. So let's look at the same chart. Here we are right now at this moment in time. And we're thinking, okay, let's do a -1 call at a lower strike. So let's say we bought Ethereum today at 2K. And we think, you know what? I just want to be cautious about my investment, but I want to still maintain upside potential. You could say, okay, I'm going to sell a 3,000 call. So we'll put our open here. And let's say it goes to December again. And this is a -1 Ethereum 3,000 call. And since it's a bear call, we also think about the long leg, which we're talking about here at a higher strike. So we're going to see that here. We're going to also open one over here. And these are paired together. So this one also expires on that date as a vertical spread, +1 Ethereum 4,000 call, right? So you would maintain your upside potential. As the underlying starts to move, it can go down a little bit and you're thinking, okay, I'm getting some premium at least. But as it starts to increase, you think, oh, well, I'm not making any more profit above my break-even point. But oh, now I am, if you have the underlying, right? This is all considering if we're going to consider a defensive strategy, we'll say +1 Ethereum, which is your underlying. This is all hypothetical. Like I think this strategy should be paired with, if you're doing this strategy, I consider it as something you'd want to pair with an investment in the underlying to some ratio that meets your risk tolerance, and you can get as creative as you want. But I like to have at least more underlying than I do my strategy. Like I at least want to have, 1.2 Ethereum or something rather than just selling covered calls alone or something like that. So you see your strategy moving, it could breach this line and you think, okay, I have my underlying investment, not making any more profit past your given break-even point, which would be somewhere around here. And then once it goes through here, you are able to start taking profit again above 4,000, right? If those are your two strikes. You can pick any two strikes you want. You could even go a lot more narrow, or you could go more wide and play with it and see which one you like best. All right. What questions do you have about bear calls? How are you doing so far?
I actually didn't understand you are you buy a call with a higher strike price, and you sell a call with a lower strike price.
Yep. So yeah, this one we can just look right at this chart. So yeah, you can see it right here. You have a +1 call at a higher strike, which is here. This is the +1. It has a higher strike. And then you have a -1 at a lower strike, which is here.
Oh, the -1 means that you are writing, or?
Yes, you got it. Yep. This is writing.
Wait, but if I'm writing, it means let's say the price is 3,500. That means that someone is buying me, and paying me the premium, and then it's gonna be in the money because it's crossing the strike price. So I will need to sell the underlying, right? But
Yeah,
then you buy again. Why do you want to sell it and then buy again?
So let me see if I understand the question. Why would you want to sell it and then buy again? Is that the question?
Uh-huh.
Okay, so this is like, in this strategy, your mindset is, like, your objective here is, one, you want to get a net credit, but you want to maintain upside profit. So if you had only this strategy and you were only writing, it would function as a covered call. Hypothetically, if that's all you're doing, right? If and only if that's what you're doing, it would function as a covered call. So if we zoom in here, we can just kind of see what that would look like. So let's say that was the only thing we're doing. This is the Ethereum chart. Here's what we're looking at. You think, okay, if this was the only part of our strategy, we would have a covered call. And you would be, as you said, you would be forced to sell to the holder at 3,000, which hopefully for you is a profit from your initial investment at, hopefully 2,000 or even less. Now let's answer your question. Oh, why do we throw this up here? I was talking to someone about this yesterday, and we had a cool conversation about it. This is like your moon line, right? Because if the strategy, if the underlying increases significantly in value, you can then return to having upside profit. So that's why you would sell and buy again, because you could be happy if you did just right here and you just had a covered call. You could be very content with selling at 3,000. But if the price of purchasing this 4,000 call is minimal and doesn't affect your net credit that you would receive by purchasing this one, then that's in probability, in terms of probability, it tends to be worth your investment to do so, because the underlying could increase through both of those strikes, and you'll return to benefiting from the upside movement at this strike.
Okay, so basically, because you are losing, but in theory, if the underlying is going up a lot, then okay, you are losing because you sold, but then you are taking the momentum of the underlying and you are leveraging by because when it reached the 4,000, you are not buying. You are just, I guess it's cash settled, no? You just get the difference. Let's say the final price would be $5,000. So in this bull market, this pump, you earn the 1,000 of the second option, and also you earn that part, but you just lose that difference, no, from 3K to 4K.
Yeah, from my understanding, from what you're saying, I think you have a really firm grasp of the concept. Yes, that's exactly correct. As far as my understanding of the question, yeah, that was a great question too. That was awesome.
Okay, thank you.
Thank you. That was great. So yeah, we talked about long puts, bear calls.
So I have another question. Would it make sense to also, let's say you want to also buy a put now, because the price can go down, no? Like you are right now the downside, you are not protected. Like with the covered call, what if the price goes to 1,000? So even with the premium that you are earning, you are not going to be able, recover. You're basically stuck, right? So
yeah. That is like exactly what you should be thinking. You don't benefit from the downside movement. You don't have protection right here, right? There's no protection.
Exactly. So I guess would it make sense to buy on swap?
It can in very many situations, especially if you have larger positions. These are exactly the exciting questions, and this is utilizing your brain and options to their full potential. Because I mean, not like just to say it's like to the exciting potential. Like this is what you should be talking about, what you should be thinking about, and this is what makes option exciting. You think, okay, I got some premium here. Now let's apply that to the other defensive strategies that we talked about earlier. Yes, you can and should very well be thinking about using that premium to some extent to purchase other defensive strategies. That's exactly what you want to be thinking about, using credit to your advantage to purchase premium in other defensive strategies. Yeah, that's exactly what that's exactly something that should be included in this kind of conversation. Absolutely. So does everyone understand that? Like premium from, covered calls or credit call verticals, which doesn't protect you from full downside movement, as well as, something like a put that is much more in terms of insurance, right? Like this one is like, if you do CC, a covered call or a credit call vertical, also known as a bear call, then you're collecting a credit, right? And that kind of helps you lower your cost average psychologically. You can say it just helps you, it just goes into your net equity and you can purchase more underlying or whatever you want. But if you do what this gentleman just suggested and apply that credit you collect to other in terms of full-on insurance to protect your underlying, then yeah, you can be at a much more advantage and defend yourself. If you price it out and the premium's right, and it doesn't affect your strategy, then yeah, it's exactly the kind of thing you want to be thinking about. So, when it comes to kangaroo strategies, we're just going to kind of point out how those, talking about kangaroo, we're really just going to breeze through this because we're over time for what I think other people want to be doing. I'll talk about this stuff all day, but I want to keep it short and concise. These are really just when you're thinking about the theta strategies, and also cheap long calls. You really want to just price it out, the benefit from extreme movement without sacrificing your capital, right? So you want to think cheap and out of the money. These are the two strategies you can be thinking about here, right? So for theta strategies, you want to think about bull puts on down moves. And then you can go back to the part of this learning group video when we were talking about bull puts. You can go to that time in the video. And then I'll put in my video that I make for this, I'll put a timestamp in that so you can go to that portion of bull puts, and you're going to say go to down moves, and you're going to plan it yourself. Like, is Ethereum down 3%, 8%, based on your selection criteria for opening that bull put strategy, right? And you're also going to think about bear calls. And conversely, when would you be doing a bear call? When you see the market moving like this, right? You're going to want to do it on these up moves, right? So if you're sitting on a moment like this in a market that is consistently doing this, then you want to do that on up moves or pumps, So you're doing.
And Daniel, I don't know if you're familiar with the protocol Ribbon, but Ribbon is a protocol now that's built a bunch of perpetual automated vaults that every week they sell out of the money puts and out of the money calls to earn premiums for people that have deposited in to those specific vaults. So there's like some really cool applications that people are building using options that allow DeFi users to earn like super high yield compared to other yield farming strategies. And it like abstracts away all of the sort of like complexities that, you know, traditional options chains sort of add. But there's like, I don't know, it's been really cool to see structured products come to DeFi, and it's going to be exciting to see even more products like build these automated option strategies using everything that we've like talked about today, and like making it easier for people to get in and to start making money with options, because you can make money in like any market environment.
I am so glad you suggested that idea and you guys are thinking of something like that. I was thinking about these strategies and how repetitive they are for me. Like I do rolling bull put strategies so regularly and it's so redundant, but it's a good consistent strategy. I always think I wish I could automate it. And I think, wow, that is so exciting that there's already something like that in the works, because it is a lot. If you want to think, okay, I'm going to automate the strategy, you have to get an API, you have to get some programming experience and stuff like that. It's a lot of work. So that is super cool. I'm really excited to look into that, because you can take these like quite repetitive and relatively low risk strategies and automate them. So, but that sounds like a much easier way to do it. I'm really excited to learn more about that. Yeah. So yeah, exactly. With options, there's like the sky's the limit, your creativity, and there's so many ways to make money rather than just up or down. And you can think about sideways as well. Yep. So the last little thing I was going to talk about was just, cheap out of the money calls or puts. And you're going to want to do that. Obviously, when you're looking at calls, when on this chart are you going to want to do that? You want to buy calls down here, right? And puts, you're going to want to buy those anytime you see that strategy up here. These are not as lucrative, I think, as far as like theta strategies are generally more lucrative, especially bull puts, I think, if you're cautious and you have good selection criteria. So to summarize, let's just say you want to be, selection is key. So before you open any position, you want to have a well thought out opening plan and exit plan. You want to know your max risk and loss. You want to have, entry, exit. Do I want to close it at 50% profit or something like that? And you also want to think about your max loss. Like you want to know your break-even point and all those values that determine that strategy. So I believe that wraps up everything we had planned to talk about. I'm down to hang around for another 30 minutes or longer and see what's on anyone's mind.
One kind of question that I have is really based on a lot of like new options traders confusion, is like, and you talked about a lot of this throughout, but the distinction between like buying a call versus selling a call. So, and not just specific to calls, but like buying options versus like selling options. Do you have any like, I guess, resources or a simple explanation of like the benefits of buying versus selling options? Because I think like a lot of people just assume that a put is the opposite of a call, which to some extent, if you're a buyer, it kind of is. But then I think once people realize like you can both buy and sell a put and you can make a profit from each, and there's different market scenarios, it kind of like makes options like a little scarier and like seem bigger. But I just wanted to to get your take on sort of explaining that distinction between like buying and selling options and different sort of reasons for that.
Yeah, so the only thing I can think of to respond to that question, and I could be just predicting the wrong question, but I'll give my best shot at what I thought. What I think the question is like, and then you can steer me in the right course if I'm off. Like, I think to simplify this mnemonic has really helped me. Like, put is like what it sounds like. Golf and call kind of rhymes with basketball. So, this is like putting, and this is like basketball, where you're aiming for an objective above the strike. But you don't want to just think, okay, it's just above the strike. You want to think about the perspectives of both the holder and the writer. So for the, like, you want to think about whether you're buying an option or selling an option. Generically, you can say, I think it helps people to equate buy with holder as as the person who kept asking really good questions was saying. I should have looked at the name that was popping up, but I was looking at the presentation. And probably I probably don't want to announce some of the names on there because they're really funny. But anyway, I'll add. Yeah. So anyway, someone in there has a really good username. So anyway, we have buy, holder, right. Those kind of terms are really helpful to equate with each other, whereas sell, writer, and obligation are kind of equated with each other. And so when it comes to call, you think of basketball, and then put, you think of golf. And those are like really easy, simple things to associate. So when you think of the holder in the game of basketball, they want their perspective is kind of at the strike, and they're in the money above the strike. So they're at a trading advantage above the strike. Whereas the writer, they see this strike and they think, please do not cross that line of a call, right? So these are both for call, holder and writer. The holder is playing offense and they want it to go up above the hoop and then into the basket, which is above their perspective, right? And the writer does not, the writer sees a red line there, whereas the holder sees a green line here, right? So this person sees a green line, this person sees a red line, and for both of them, it's in the money above the line. But for one of them, it's a trading advantage, and has the right to buy above that line. And for the writer, it's kind of like a disadvantage, and it's the obligation to sell below that line. And then for the writer, obligation to buy. And then for puts, it's kind of like, so that was like a really quick way to summarize it. And then for puts, we have a put, and then we have a holder and a writer. And in this case, if we're looking at an individual option or a net strategy, where if you're like a net holder or a net effect writer, then yeah, I love your emoji there. That's great. So, yeah. So if we are looking at this strategy in terms of like the put holder or writer, then they're going to have the holder of a put has the, oopsie, I messed up this. I wrote O when I said R. This is the right to buy, and the put holder has the right to sell, and the put writer has the, what's the inverse of RTS? PB. And once people see, they're just saying, okay, I have the obligation to buy star, like where star means if exercised, if holder exercises. And it's really the market who determines the, like, it's everything's in a liquidity pool. These two people are not actually tied to each other. There's like a, you know, a clearinghouse where they're going to say, okay, so many people have exercised their contract. That means we're going to have to assign so many people who have a writer position. So then they kind of randomly pick those people. They're not actually paired with each other. Like, they're never going to know who the other one is. I think so. So yeah, that takes care of the strategies. Where you see the call, they kind of want it to go above the strike. Where put, you're looking below the strike. And those kind of analogies I have found to be very helpful. And that where you can see like the person who's putting, they have like a long position. They're the putter and they're on offense, and they want the ball to fall below the cup. So this would be the holder. And then the writer is on the other side on defense. Like, they're watching, you know, and they're just thinking, no, please don't go in. Like, they're saying they see that line of defense in the sand here below their surface as a put holder, as a put writer, I mean. So they have a negative position in the put of that strike, and they see that strike below their surface, below the level of their perspective, and they're at a disadvantage when it goes into money. So for a put, ITM is below the strike, because obviously if you have the right to sell something higher than it's presently trading at, you're at an advantage. And if you have a call, if you have the right to buy something at a lower price than its present value, then you're at a trading advantage, right? So the call, you're thinking buy low, sell high, and that ticket, that coupon, gives you the right to do that. Whereas in puts, you're thinking about, as another attendee so eloquently suggested, the put is like insurance. So the call is like a coupon, the put's like insurance. Call rhymes with basketball. Put is like golf, where you want the ball to go below the surface. And with the call, it's like basketball, you want it to go above your perspective. Does that address the question somewhat, and like the strategies you would be thinking about?
Yes, thank you for that. I know that'll be helpful for everybody.
So you can see the call. The call holder is bullish. The put holder is bearish. And so yeah, I'm hanging out. If anyone has any questions they want to type or shout out, anything, say. Quick review of anything, if anyone wants. So yeah, we talked about bull strategies.
Yeah, I just wanted to say thank you. Like, really great presentation. I mean, I could understand the in the past what is a put and call, but I didn't like get the idea of what holder and writer is, and now I do. So I feel smarter. Thank you.
Yeah, awesome. Yeah, that's a great thing. Yeah, think about that. Those rights and obligations. And yeah, those are really helpful to think about. You have the right to buy or the right to sell, and you know what those are. One's a call, this one's a put. Or you have the obligation to sell and the obligation to buy. And it's the same thing. These are both for holder, writer. Yep, exactly. Cool, so I'm just going to stop recording right now.